Let's start off with the fact, Kenneth, that the market has been seen to trade below the 3,500 resistance level. It had effectively become a new resistance. Was it the risk aversion we saw concerning events in Greece and Italy? And how will the markets be impacted now that we're seeing resolution to some of these political problems in those key markets?
I think what's mostly is affecting our markets is not even, about 2-3 weeks ago, foreign investors were reacting to global events, especially what was happening in the European Union. But also locally, since the CBR went up by 550 beeps, we've also seen the money market move up to levels of, interbank rate has gone up to levels of about 30%. So what we're seeing is a lot of local institutional investors moving their money from the equity market to the money market, where they're getting returns of, 20% and above.
All right, now in the past week, we've also seen the FTSE index being introduced to Kenya. What does that mean for market efficiency, for liquidity, for the evolution of new products?
We're yet to see the full legislation that the CMA and the Nairobi Securities Exchange have been working on to introduce new products. But it's a step in the right direction. They're really keen to introduce such products as ETFs. So, it's actually a step in the right direction. It's not gained so much relevance at the moment, but with time, I think the market will start to recognize these new indices as quite important.
All right, anything that's catching your eye on the equity side before we move on to a lot of activity on the fixed income side?
I think the equity side, I'm just watching. It's not really a good time to get in. Prices seem to be dipping. The rally we saw over the last month has begun to slow down and may even have turned. There's a lot of supply across the board of most of the counters. So I'll just sit it out, watch for probably support level and get back into the market.
We do know that also fixed income and bonds have been really subdued because of rising interest rates, because of the general state of the economy, because of global factors. But these rising interest rates, we've seen them have a direct bearing on treasury bills and that the rates are rising. What does it mean for corporate bonds?
It's actually not a very good time to issue corporate bonds. HF had announced the other day they were looking to do a 25-year bond. I think they may shelve that idea for the moment, probably wait for rates to ease at some point in the coming year, in 2012. Also, there's also a local bank that was looking to issue a corporate bond also this year. I think those plans have also been shelved for the time being. What we're seeing, especially is a lot of investors are quite risk averse. They're staying at the short end because rates have been rather volatile. So most people are staying within the money market, and also we've seen huge undersubscriptions for the 91-day, and this is the reason being the tight liquidity in the market. Most people would rather play on the money market, and also banks are tight on liquidity. They'd rather stay liquid, keep their cash. So the 91 days subscriptions have been, averaging about between 30 and 50% for the last 4 weeks. But CBK are really keeping a lid on the rates.
Kenneth, I still want to focus on corporate bonds because there are 19 corporate bonds on the market. Many companies have pegged the rates to the treasury bill rates, but now that we're seeing these rates go up, yields have gone up as much as 6 percentage points. So in terms of value for investors, we've got a bit of a problem here.
That's quite true, especially, I think in the most of them, when it comes to, especially floaters, when it comes to the coupon, paying off coupon, and most of them are based on the 182-day T-bill. They're actually feeling the pinch at the higher financing cost of this debt. So, it actually does reflect on some of their books. But the thing with the corporate bonds in the market is that the companies that have issued them, it makes quite a small bit of their total debt. So the effect on their bottom line is not quite felt, except maybe you can in terms of the largest corporate bond, Kenyan. But also Kenyan is a fixed bond, not a floater, so this would not affect them.
You were giving us an indication of 10 years, and some people who are bullish about Kenya would probably buy longer range papers that will mature in the next 20 or 30 years because they believe in the growth of the economy long term. It's those looking at the shorter end, as you're saying, who are less optimistic. Where should people be putting their money as they enter this particular side of the market?
I think traditionally when interest rates are moving up and the market is volatile, when there's uncertainty in the market, the prudent thing to do is stay at the short end and wait for some stability. Long term, basically, a lot of investors, there are actually no new investors in our fixed income market. Most of the investors have been around for the last 4 or 5 years. So a lot of them are already holding bonds that had been issued 2 or 3 years earlier. So when it comes to going in at the long end, buying, everyone would love to buy a 15, 20-year paper at levels of 18 to 20%, but that would end up hurting your portfolio and would, hit your book. And it's the cost, when you do the cost-benefit analysis, it's actually better to stay at the short end and hope that the long end stays stable and actually begins to ease in the coming year.
And finally, the shilling, we did see it rally over the last 7 days, gaining as much as 3.8%, trading somewhere in the region of 23 shillings, 93 shillings, 92 shillings to the dollar. What are your expectations for the currency and what's going to inform that?
I think the initial rally we saw after the MPC announcement, that market euphoria has sort of waned off, and we do expect it to continue strengthening, but at a more stable rate. Basically, when now the effects of the policies that the MPC set in place start to take effect. Market is very tight. People are liquidating their dollar positions to fund for funding, so I expect it to continue strengthening. But for example, today it behaved pretty well. Started strong, but at some point in the afternoon there was some slight corporate demand that made it weaken somewhat. But we expect it maybe to continue trading range bound between levels of 90 and 95.